Let's take a look at fiscal policy tools in public administration. The primary tool of fiscal policy is taxation, which has traditionally been viewed simply as a means of raising government revenue. Taxation is the primary means by which governments raise revenues for public services. Taxes can be collected from individuals and corporations on income, earned and unearned, profits, property values, sales, and services. For the past 50 years, however, taxation and tax policy have also been used to influence the volume of spending by private citizens and of organizations. Raising taxes has at times been a weapon against inflationary spending because it reduces the amount of disposable personal income. Reducing taxes, for example, to increase consumption and spend your way out of a recession works very nicely, assuming that such spending doesn't trigger increased higher interest rates and inflation. The uncertain condition of the national and global economies raises new questions about how to use tax policy as an instrument of economic management. As with tax policy, there have been fundamental changes in attitudes towards government expenditures. Gross domestic product, GDP, is the sum of goods and services produced by the economy, including personal consumption, private investments, and government spending. Millions of businesses, individuals, and state and local government institutions depend on federal revenue for basic services and support. These installations pump millions of new dollars into the local and state economies. This has the effect of increasing tax revenues in all taxing jurisdictions, both state and local, and in general, strengthening the locality's financial basis because of new jobs created and increased population. A third fiscal policy tool is management of the national debt. The national debt is the accumulation over time of the difference between the amounts the federal government spends and collects in taxes. When a government sells bonds, it changes the composition of privately held assets, converts private assets to money to bonds. National debt is the cumulative sum of borrowing necessary over time to pay the difference between the amount raised and the amount spent in the annual federal budget. Whereas the national debt represents cumulative red ink, the budget deficit is the difference between how much the federal government collects and spends every year. In state and local government, debt management is similarly complex, if only because many state constitutions require both state and local governments to operate with balanced budgets. Nevertheless, most states and localities have extensive bonded indebtedness, meaning that they issue interest-bearing bonds, generally free from federal taxation, to raise funds for specific stated purposes. Bonded indebtedness is a revenue-raising tool for governments to issue notes or promises to pay a certain amount, principal, at a certain time, maturity date, at a particular rate of interest. Tax expenditure financing is a practice of giving favorable tax breaks for certain kinds of spending by individuals, nonprofit institutions, religious organizations, professional sports franchises, and corporate enterprises. Tax expenditure financing is revenue losses from provisions in the federal, state, or local tax codes.